Portfolio Builder members, welcome to our Tuesday Trade Alert. Now that our audience is getting quite a bit larger, I got to throw out that important disclaimer. Trading is risky and you can lose your entire investment. These results are based on hypothetical model portfolio and not real money trade. Some of our staff does follow our trades, but they get the trade alerts at the same time as everyone else to avoid front running. A quick review before we jump into today's trade alert and our overall view in the markets. And again, I do have a live chat, so welcome to everybody in there. I think we got Dean, Victor, we've got quite a few watching now. Feel free to say hi. And Tom Hendricks, welcome. I recognize your screen name there too. We have a income-based trading strategy for retirees that protects capital, and this is how we currently recommend $100,000 be allocated. 100 shares in the SPY, which takes advantage of 3 option expirations a week. This is great for generating income by selling call options and then protecting to the downside with cheap put options. 100 shares of the SPY costs approximately $30,000 and is our largest equity position. On Tuesdays, we take advantage of weekly options with a similar strategy. We're still selling a call option for income and buying a put option beneath, but we're looking at the top holdings of the SPY and trying to determine the best bet for the foreseeable future in terms of generating a hefty return with low risk. So right now I really like Facebook. Previously we've traded either silver or Apple as our core positions. Currently Facebook is the pick. We'll take a look at why in a minute. And then our biggest position outside of equities is in the US Treasury market, long duration 20 plus year treasuries in the TLT. So that long duration makes any fluctuation in interest rates generate big changes in the value of the TLT, which is perfect for our strategy, which once again is to sell call options for consistent income and then purchase put options below the underlying asset. So the move on the TLT has been absolutely unbelievable this year and has definitely brought in a substantial amount of profit. What's important about our overall strategy is that typically, and this hasn't always been the case, but typically when the SPY goes a little bit down, the TLT goes a little bit up. Then the TLT goes a little bit down and the SPY goes a little bit up. In the big picture, they've been moving up together, but when one has volatility, the other tends to surge higher. This allows us to generate a very consistent return with extremely low drawdown. Now, back in December when we launched this portfolio, we were recommending a 2.5% position in the buy and hold portfolio in Bitcoin. And that's when the Fed had come out right before the Christmas massacre, and they told us interest rate hikes are on autopilot, quantitative tightening is on autopilot, everything's wonderful in the economy, and we're going to push up the rates so we have some ammunition to fight a recession. Well, stock market puked all over itself, and we all know what happened next. The Fed has slowly capitulated and followed the path of all of the other central banks around the world. The big news coming up is that the FOMC has a meeting on September 18th, and this has typically, except for the last meeting in July, has resulted in some of the biggest moves to the upside in equities. And right now, the anticipation is that they will drop rates by around 50 basis points. And we already saw yesterday that they're starting to buy up U.S. Treasuries. So we are officially back on track for QE, which is extremely bullish for equities. So this is our current holding now. As the Fed has become more and more dovish, we've become a bigger and bigger allocation in our buy and hold portfolio. Currently, I'm recommending 250 shares of GDX, 0.1 Bitcoin, and 5 Ethereum. So we went from a primarily GLD position with very little in the cryptocurrency space to rotating after this latest trade escalation into GDX, which is the gold mining ETF. Most of it goes to two huge gold operations, Barrick Gold, and then another one with the ticker NEM. And so these are primarily owned by BlackRock and people like Stanley Druckenmiller, and these represent a very good way to protect our portfolio against what's deemed to be a risk of inflation. Now, we're already seeing inflation all over the world, not in the US perhaps, at least with the metrics they use to guide the central bank. But if we go look in China and other parts of the world, they're having very, very fast inflation. So the fear for buying gold is as real as it's ever been, and this could be a very nice position to help increase our bottom line without a whole lot of risk. Now, for those of you who don't want to trade on all of our trade alerts, or you have a little less capital, you might consider what we call the light strategy. That's just 100 shares on the SPY, which costs approximately $30K, and then 200 shares on the TLT, which we trade Thursday. And this allows you to rebuild the same strategy, a little less ammunition on the equity side. You're not taking advantage of our weekly trade alert, which has delivered the highest return of our income trades, but this will simplify your life and make it very easy to follow. So that's the two allocation options we have. Again, if you want to trade in multiples of about 100,000, this is our breakdown and our trade alert schedule. Every trade comes out at noon Eastern. And if you want to trade with just about half of that, here is the recommendation. Now, if you are an expired member, you're going to be getting this trade alert delayed. You won't see the actual trade pick for today. You'll just get to see the review of what's been happening in our total portfolio. If you want to upgrade and make sure you get the trade alerts real time, call Dean 505-322-7515 for special pricing. And a few other quick reminders, we do have a live Q&A webinar for our paid group Wednesday at 1 Eastern. This is with Zoom. It's not just the live stream where you can chat with me. And then we have a free webinar for non-members on Thursday at 1 p.m. Again, you'll get your invite via Zoom in your email, and we also send out a text reminder. If you have any support-related questions, add this phone number to your phone book, 505-203-0396 for Victor. And again, if you are not subscribed to the channel, plus have that little bell notification ring, I suggest you do that. You'll get our live stream daily. A lot of people feel like the live stream is just as valuable as our paid product. And so if you want it to automatically pop up on your YouTube app, just subscribe to the channel, click the bell. All right, let's jump into what's going on in our portfolio and our broad view on the market. We'll start off with today's trade alert. Of course, I won't show the exact trade recommendation for today. If you do have questions about it, because you're a member, feel free to ask me questions in the live chat. But what we will do for now is review. So this portfolio in total is up 16.79%, trading once a week with a quick 2-minute trade. It has had plenty of volatility. It is aiming to get a bigger return with more risk. It represents a smaller part of our total portfolio. And if you only look at this year's return, it's actually up 22%. So it took a little hit in December, losing 4%. As you can see, I'll zoom in a little more. But this year's been pretty strong. We had 2 losing months in May and July. We're only up 0.5% in August, but the other months have returned 7, 3, 3, 1, and 6%. And that's rounding down, not up. So we're very happy with the returns in this portfolio, and our outlook on equities remains very bullish, and I'll start to describe why today. And again, you can see I have 37% of the total portfolio trading the Monday, Wednesday, Friday trade noon Eastern. We are trying to get a little extra profit and take on extra risk on the Tuesday trade. This is also an alternative trade if you don't want to trade the SPY 3 times a week and you'd rather get a little more juice in your equity portfolio. The Tuesday trade does that. It's less diversified, it has far more risk, but it aims for bigger returns. And so as long as you are balancing it out with the Thursday trade alert plus our buy and hold portfolio, it might make a lot of sense if you want to trade less and make more. Now, if you're more interested in absolute security and safety, and you're happy to just plug along with small, consistent profits, it's very hard to beat our SPY trade alerts Monday, Wednesday, Friday. Okay, quick review of the last trading period. We came off with a loss of $2.18 a share. So that's about a 1% loss week over week, considering a share costs approximately $180. And our trade alert coming into this week has the potential for a maximum return of just over 4%, or about $700 of income per 100 shares. That's a great return if we can pull that off 52 weeks a year, which I don't think we will, but if we did, that is over a 150% return per year. So we're not trying to get that. Don't expect it. But right now, I do think we have a cooling in the trade tensions, which will result in a very bullish move in equities. And particularly, I really like Facebook. So we'll take a look at what Facebook has going on in a few minutes here. I'll click through the track records one more time just to review. Our total return, if you do overlay all the trades, which is only a 2-minute trade 5 days a week, right at noon, we only have a single losing month, and that's the month of July. And August continues to climb higher. This bond portfolio is out of control, trading at 14.5% return, total return. And that's really driving a lot of easy profits over the past several weeks. I do suspect the bond portfolio will start to slow down. We'll be playing that a little tighter on the collar this week, expecting the current move to potentially pull back a little bit or slow down at least, and for the equities to catch up. And again, these track records and links are included in the trade alert so that you can easily access them at all times. So you can click on this link in your trade alert email and go through all of our trades in great detail. Okay, so moving along, let's take a look at why we are bullish equities right now. We just got through the latest round of tariff escalations, and I'll be the first to admit that it could escalate even more at any point in time. But I do think we just got past the most recent escalation, and now that there will most likely be a period of easing, which will allow equities to travel higher. The big picture, from my point of view, is focusing on a few things. Number one is the conversion rate of the dollar against other currencies. So the two main competitors of the dollar are the Chinese currency and the euro, both of which are dramatically weakening against the dollar. So they are by design trying to devalue their currencies, and this is in effect causing a rush to purchase dollars, U.S. equities, and U.S. bonds. So let's take a quick look at what we have in our live stream doc. And again, I do want to point out that you can gain access to this live stream doc by just going to the description box in the YouTube video, and there's a link to our daily live stream where I've pulled out the important stuff related to our current trade alert. Okay, so this is my list of stocks I typically follow day to day, and so we are looking at Facebook, FXI, that's the Chinese large cap ETF, primarily banks and construction, but a little bit of the tech companies in there too, like Tencent, Alibaba, Baidu. I have a lot of our capital focused on GDX right now. That's the gold miner ETF. HYG is the high yield corporate bond. We're not trading that, but we are watching its health as an indicator for the credit market. IWM is the Russell 2000. We're also using that to gauge the potential long-term health of the stock market. Currently, that's relatively weak. LQD is the investment grade corporate bond fund. That's the one that, if it were to pull back, would be disastrous for U.S. equities. And that's because a lot of this rally is based on corporations in the top tier, in the investment grade basket, borrowing money at very low rates and then using that money to buy back their own stock. It's complete lunacy, but it's what's been driving the market, and this is a critical stock for us to follow. SPY represents the bulk of our equities portfolio. TLT is our U.S. Treasury, and that is the key stocks we'll be covering today. We also take a look at some Chinese companies in specific, and also 2 banks in Europe, which could create systemic risk. Okay, so here's a look at Facebook. Facebook has quite a monopoly, at least in the US, in the social media space. But if you were to make it more broad, they really have a monopoly in the phone app business. They have more people who use their apps than any other company in the world. And there's really only a few competitors that are making a dent, and they're Chinese ripoffs of all our products. Go figure. We'll take a look at some of those in a bit. But Facebook is relatively new to the scene in terms of being a public company. Its growth has been unstoppable. Its revenue growth has been unstoppable. And they're just now starting to figure out how to monetize this huge user base, the largest user base in the world. So we'll take a look at that in a minute. Plus, they have a new project that may or may not be approved that could really dramatically increase their market capitalization, which is currently at about $500 billion. And that's the Libra project, which we'll take a quick look at. It really solves some big problems in the world, in the big macro picture that's developing over the next several years. And so I don't think everyone's really caught on to just how important this project is if it were to really come to life. Regardless, there's really no competitor in the US that's going to replace Facebook or Instagram. And because of that, they really have the moat around the business. They just got past a lot of government scrutiny where they had to pay a $5 billion fee. So it is selling at somewhat of a discount right now. And so I think we have a pretty smooth ride on Facebook anytime there's a pullback in equities, and we're not seeing a deterioration overall in the earnings of the top companies. So we can see market cap at $514 billion and net income at $17 billion, $62 billion in revenue. Now you go compare this to a company like Apple or Amazon, and it's considerably smaller. So this business certainly is selling for a premium because of this perceived monopoly it has in its sector. There's really zero competition in the Europe or America, and really its only competition is in this closed market in China, which we know is under great threat because of the trade war. Now, unlike Apple, who has a third of its business and most of its production in China, Facebook's relatively independent of any sort of trade war dispute. So I do like it going into this next election cycle, as well as into a period of time where we expect central banks to drop rates towards zero, be irresponsible with the money supply, greatly expand the monetary supply, and start buying up government debt. So all of this is huge if they can pull off their Libra project. Facebook's balance sheet is good as gold with zero long-term debt. Its user growth and revenue growth has been nonstop. And now they're working with MasterCard, Visa, PayPal, eBay, some big private equity firms, Coinbase, to jump into the cryptocurrency world. Now, everybody who's heard of Bitcoin and all that before was looking at it from the point of view that they wanted to get out of the government controlling their transactions and taxing their income. And that's really what Bitcoin was all about. It was this new currency with no administration. No one gets to control how much money's in it or outside of it. And the infrastructure is designed by all these miners who have to sit there and spend a ton of money mining the Bitcoin. And perhaps Bitcoin has its place long term. And certainly you can see we do have a tiny position of about 1% of our total portfolio in Bitcoin. But it really acts as a much different role than the Libra project that Facebook's offering. Now, Facebook wants to roll out its cryptocurrency backed by fiat currencies, but it'll be a basket of the top currencies in the world. So we're talking about the dollar, the yen, not the Chinese currency, and the euro. But then they're also hedging it with futures contracts. So it's not really clear what they're going to do. They're trying to get away with it not being an ETF. There's plenty of ETFs that already have baskets of currencies. But Facebook's trying to come in there and say it's not a security, that it is a stable coin that's perceived purpose is to just retain value. And so if you use the Howey test, which is what they're trying to use to get into this space as a digital currency and not as a security, is they're using the Howey test, which says if you invest in a product to gain a profit from the managerial efforts of another group, then that is a security. And so their whole argument is that people will buy the Libra coin not to generate a profit from the efforts of Facebook or its group. So it'll be interesting to see if they can pull this off. I think they can. There's other cryptocurrencies already not being deemed securities. So it seems like the path should be relatively straightforward. Now, of course, we're not banking on this coming true. It's pinned to go live next summer. And they have the potential to roll this out to 2.4 billion people across the globe. It could, in the long run, become a global settlement structure that could potentially become more powerful than the dollar. Now, not in the next year, but in the next 10 to 20 years, the view of how powerful this could make Facebook is quite incredible. So we can see right here that Facebook has quite a few of the top apps that are used by the most U.S. consumers. Facebook for 1, Facebook Messenger for 2, Instagram for 3, and then they also have a very popular chat app. The only real competition is Google with their YouTube app and their map product and Gmail. But as you can see, they're really quite different products that really have no competition. So in terms of social networking, Facebook has an absolute monopoly, and there's really nothing that can stop it. The bigger competitors, really the biggest competitor right now is two Chinese companies, which is TikTok. Snapchat, I would say, is kind of dying down. It had its chance to be bought out by Facebook, but turned it down. And so really, there's just nobody standing in its way right now. And also, they own WhatsApp, so they also have the biggest chat app. Now, in terms of some of its competition, I just wanted to point out this story that's untangling with China. They are ripping off every little thing under the sun and sticking a new tag on it with their brand name. But here we have a YouTube ripoff from China. Next, we have QQ, which is a ripoff of Facebook Messenger. Then we have WeChat, which is essentially just a competitor to Facebook's WhatsApp. And we have Facebook's product, Instagram. Now, they bought Instagram for $1 billion. Now it's potentially worth $100 billion. And that's just in several years of growing it. Facebook's Messenger app. And so just imagine this Libra coin being tied into all of their phone apps simultaneously and then rolled out to 3 billion people across the world during a period of time when most of these countries are being forced to devalue their currency in response to China devaluing their currency in response to these tariffs. So if they pull this off, they're going to have a huge demand, at least around the world, of people whose currencies are devaluing, they're facing inflation. They're going to want to ditch their currency and buy into Libra, which is also being rolled out to some 10 million merchants. This could grow very, very quickly, and it really has very little competition in front of its way. So that's a quick review of why we like Facebook right now and expect it to break into new highs potentially by Christmas, as we expect the FOMC meeting to lower rates and give us another goose in the stock market towards new highs. LQD, here's a look at that chart where we can see the corporate investment grade debt is still extremely strong. This means these companies have free access to capital, or nearly free, which they're turning around to buy back their own stocks. Until this cycle is cracked, it's going to be very hard to end the U.S. bull market, especially when the rest of the equities markets around the world are suffering from the slowdown in China, which was driving most of their growth. And it's perceived that China is out of ammunition in terms of credit. They're facing inflation. They need to slow down the credit expansion, otherwise they could be in a lot of trouble very quickly. They're having banks fail. So the overall picture is there's really nowhere else to invest. Here's a look at our TLT. U.S. bond market is now 95% of the positive yielding debt in the world. So the rest of the debt is really just an insurance policy that mostly big banks are buying, that if things get out of control, the bond prices will push even higher, and they can sell those to the central banks to get out. Okay, Deutsche Bank and HSBC are two high-risk banks that we're following for signs of potential systemic risk in the banking sector. Deutsche Bank is the big German bank, and HSBC, the big European bank. There's a lot of rumors that HSBC was actually the bank financing China's currency, and now they have apparently broken ways. Lots of big dogs in HSBC are being fired, despite them having considerably strong earnings. So there's a lot of rumors circling around this relationship, and something that we definitely want to keep a close eye on. The Chinese companies, I am carefully watching to see if they start to really have stresses. This is obviously potentially a risk for our U.S. equity positions. And we have seen actually quite a few times now that before the turmoil will really rack it up, before we see the Chinese currency start to devalue, and before we start to seeing selling off in America, we're first seeing weakness in China. And so we saw that actually Thursday last week, before Trump came out and started to get mad at the retaliation from the Chinese companies. So strong signs here. Here's a photo from China about Costco opening up their first Costco in China. People are walking around the streets to get in. The yield curve is inverted once again from huge pressure on people who want to buy the 10-year Treasury for whatever reason, including the Fed was buying up this 10-year Treasury, which is interesting. But you're getting a better yield on the short-term debt compared to the longer-term debt. which has always been a sign of weakness, a sign of recession. And if we do look at the big picture, we can understand that people are flying into these products as an insurance policy in case of recession. And this is all due to China's slowdown, causing the rest of the world to slow down at the same time, as they were the key buyer and driver of the most recent 10-year bull market. We're also seeing insiders are starting to sell at rapid pace. Of course, they're always selling at some degree. The big wild card that I'm definitely concerned about would be if the Fed were to disappoint the markets come September 18th. If they did not drop rates, we could potentially see a sell-off in equities and bonds, and this could be quite devastating. So I think it is unlikely, but if they were to just remain put or only drop by even 25 basis points, I think the markets might get quite upset. And again, this is another reason why we always have put options underneath our assets. We know we're in the middle of a bubble. I expect this bubble to get tremendously larger before it pops, but this is certainly something we need to be concerned with. If they were to try to put pressure on Trump, who knows what sort of connections could be there. Another big wild card is that we're going into the next election cycle. Okay, here's just a quote. Will the Fed and ECB start buying equities and ETFs? We know that some central banks, like the Norwegian bank, has $100 billion in U.S. equities. The Japanese central bank owns 60% of its own stock market, which has become a joke. And there's other central banks who are some of the biggest buyers of the U.S. stock market. A little bit on Facebook's history. They've acquired 76 other companies. I suppose one of the biggest threats to Facebook would be if they were potentially broken up, but I don't think they will. They offer free products, so it's hard to say that they are creating a monopoly and taking advantage of people when they give away their products. And anyone who could potentially become a competitor has been swiftly bought out, and you can go through their history. There's only a handful of Chinese phone apps that potentially show any risk, but I really don't think so in the U.S. Here is the conversion rate of the Chinese currency to the dollar, and as you can see, if we go back to last Thursday, right here on the 22nd, before the trade war escalated, you can see that it jumped way up to over 7.1 conversion rate. That same day, we saw the Chinese stocks selling off, and this was during a period where U.S. equities were up. So definitely a easy heads up is to pay close attention to Chinese equities and then the devaluation of the Chinese currency. So we're keeping a close watch on this, and it is going up, up, up. The more this goes up, the bigger Libra could be, the more money that may flow into U.S. equities, the dollar, and the U.S. Treasury market, and also into gold and Bitcoin. And that, folks, is a wrap on our outlook for today. If you are still on a free trial or an expired trial and you want to upgrade, call Dean at 505-322-7515. I'll just review our trade schedule one more time. Monday, Wednesday, Friday, we trade the SPY with 100 shares. That costs $30,000. We're selling call options on top, put options below. This generates consistent retirement income. Tuesday, we go for a bigger return with the same strategy on the weekly options. Currently, that's Facebook. In the past, we've rotated between Apple and the Silver ETF. All have done very well for us, and this is our highest returning income strategy. The easy money has been in our TLT portfolio, which only trades on Thursdays. It's still selling call options and buying put options as a caller trade. And this has just been the easiest, most obvious trade all year long with very, very few losses. And so for the time being, this continues to be an easy pick ahead. The biggest hiccup for all of our portfolio right now would be the Fed disappointed at the September 18 FOMC meeting. Otherwise, I'm quite happy to hold all these positions. And I think we're going to see all the central banks continue to do what they've been doing: lower rates, print money, support their government debt, and expand this bubble as long as they can. So that's a wrap for today's content. If you do have any questions, I'll keep a look on the live chat. And if not, tomorrow, remember we have our SPY trade alert at noon Eastern. And we also have our paid member only webinar. Thursday we'll have our free webinar, and that will be also at 1 Eastern. So thank you everyone for your time today, and we'll have another live stream at the same time tomorrow.